$38 trillion. That is not a projection. That is not a future estimate. That is the actual level of United States national debt as of late 2025. And if you think that number is abstract, distant, or irrelevant to your daily life, you're making the same mistake millions of people have made before every major economic collapse in history. Because what matters is not the number itself, but what happens next. While public attention remains fixed on headlines, elections, and short-term market movements, something far more important has been happening quietly beneath the surface. The largest financial institutions in the world have begun moving capital out of dollar-denominated assets. Not loudly, not dramatically, but systematically, methodically, and with historical precedent. This is not speculation. It is visible in Treasury data, capital flow reports, central bank balance sheets, and institutional filings. And it follows a pattern that has repeated with disturbing precision for more than 500 years. Every major reserve currency collapse in modern history followed the same sequence, the same stages, the same warning signs, the same ending, and the United States has now entered the most dangerous phase of that cycle. Global debt has reached approximately $251 trillion, according to international financial institutions. That represents more than 235% of global GDP, the highest level ever recorded during a period not defined by total war. United States debt alone increased by more than $2.3 trillion in less than 1 year. That pace is not sustainable. More importantly, it does not exist in isolation. Corporate debt, household debt, student loans, auto loans, and credit card balances have all expanded simultaneously. This is not organic growth. This is leverage layered on leverage, sustained by confidence rather than fundamentals. And history shows that confidence is the most fragile asset of all. Every reserve currency system follows a 4-stage cycle. Stage 1 is ascension. A nation emerges from conflict or innovation as the dominant economic power. Capital flows inward. Its currency becomes the standard for global trade. Confidence is absolute. Asset prices rise. Productivity increases. The future appears limitless. This stage typically lasts several decades. Stage 2 is overextension. Success breeds complacency. Governments expand spending beyond revenue. Military commitments grow. Social programs multiply. Debt increases faster than economic output. Central banks intervene to smooth volatility. Asset prices inflate. The public feels wealthy, even as structural imbalances deepen. This stage can last decades as well, but it always ends the same way. Stage 3 is the silent exodus. This is the phase most people never see until it is too late. Smart capital begins to move, not retail investors, not politicians, institutions, central banks, sovereign funds, large asset managers. They do not announce their departure. They simply rebalance. They reduce exposure. They diversify into other currencies, commodities, jurisdictions, and real assets. At first, the movements are subtle. Over time, they accelerate. This phase usually lasts between 18 and 36 months. Stage 4 is collapse. The currency loses reserve status. Foreign demand evaporates. Inflation accelerates. Interest rates spike. Asset prices fall together. Banks fail. Pensions weaken. The middle class absorbs the damage. Political instability follows. And the public asks the same question every time. How did we not see this coming? This cycle is not theoretical. It is played out repeatedly. Spain in the 16th century. The Dutch Republic in the 17th century. Britain in the 20th century. Different cultures. Different technologies. Same financial mechanics. Spain controlled enormous flows of gold and silver from the Americas. Its currency dominated global trade, but relentless military spending and debt accumulation hollowed out the economy. Smart capital moved north to Amsterdam. Defaults followed. Inflation surged. Power collapsed. The Dutch Republic then inherited financial dominance. Amsterdam became the global banking center. The guilder was the reserve currency. But wars, leverage, and financial excess eroded the system. Capital moved again, this time to London. Britain rose, dominated global trade for 2 centuries, and financed the modern world. But 2 world wars and decades of debt destroyed the pound's dominance. By the mid-20th century, Britain required international bailouts. Reserve status shifted to the United States. The common thread in every case is not military defeat or technological failure. It is mathematics, excessive debt, currency debasement, and loss of confidence. The United States followed the same path. After World War II, the dollar became the global reserve currency. To understand why the silent exodus matters more than headlines, you have to understand how capital actually behaves during late-stage reserve currency cycles. Money does not wait for confirmation. It moves on probability, risk asymmetry, and long-term survivability. By the time collapse becomes visible to the public, institutional capital has already repositioned. This is why Stage 3 is always misunderstood. On the surface, markets may still appear functional. Stocks can remain elevated. Employment numbers can look stable. Political leaders reassure the population. But beneath that surface, the structural supports are weakening. In the current cycle, the pressure point is not just debt, but debt servicing. The United States now spends over $1 trillion per year on interest alone. This is not repayment. This is the cost of maintaining the existing debt. That figure grows automatically as rates rise and as new debt is issued. It competes directly with defense spending, social programs, infrastructure, and everything else. When interest becomes one of the largest line items in a national budget, flexibility disappears, policy choices narrow. Every shock becomes harder to absorb. Central banks respond predictably. They attempt to stabilize markets through liquidity. They intervene when volatility threatens confidence. But liquidity is not neutral. Every intervention distorts price signals. Every expansion of the balance sheet delays adjustment while increasing the eventual cost. This is why asset prices inflate even as real purchasing power stagnates. Money flows into financial assets faster than it flows into productive capacity. The economy becomes dependent on asset appreciation rather than output. That dependency is fragile. Stage 3, capital flight, does not look like panic selling. It looks like portfolio optimization. Treasury exposure reduced slightly, currency reserves diversified marginally, commodity allocations increased quietly, infrastructure investment shifted abroad. Gold accumulation resumed gradually. No single move is decisive. Together, they are transformative. And this is exactly what history shows. When Spain collapsed, capital did not flee overnight. It leaked out through banking networks. When Amsterdam fell, wealth migrated through merchant families and trade houses. When Britain declined, corporations, talent, and investment redirected over decades. The mechanism is always gradual until it suddenly is not. What makes the current cycle uniquely dangerous is scale. Never before has a reserve currency issuer carried this level of debt relative to global output while simultaneously serving as the foundation of the international financial system. The dollar is embedded in trade, reserves, derivatives, commodities, and debt markets worldwide. That means adjustment cannot be clean. When confidence weakens, the feedback loops amplify. Currency weakness raises import prices. Inflation pressures wages. Higher rates strain borrowers. Asset prices reprice. Financial institutions face stress. Governments intervene again. The cycle feeds itself. Another overlooked factor is demographics. Prior reserve currency collapses occurred in societies with younger populations and lower entitlement burdens. Today, aging populations increase fiscal pressure automatically. Pension obligations, healthcare costs, and social spending expand regardless of economic conditions. This reduces the ability to grow out of debt. Growth becomes policy dependent rather than organic. Markets sense this long before voters do. At the same time, geopolitical fragmentation accelerates monetary diversification. Trade blocs increasingly prioritize resilience over efficiency. Bilateral settlement agreements reduce reliance on any single currency. Payment systems become regional. Energy trade experiments with alternative pricing. None of this replaces the dollar overnight, but reserve status is not binary. It erodes gradually. An erosion is enough to trigger stage 4 dynamics. The most dangerous misconception at this point is the belief that military dominance guarantees monetary dominance. History does not support this. Spain commanded the most formidable armies of its era. Britain ruled the seas. Neither escaped financial mathematics. Military power can delay consequences, but it cannot reverse balance sheets. It often accelerates fiscal strain instead. Another misconception is that technological leadership prevents collapse. Innovation does not offset excessive leverage. The Dutch Republic was the most financially advanced society of its time. Britain led the Industrial Revolution. Both collapsed as reserve currency issuers. Technology increases efficiency, but it also increases scale. When mismanaged, scale magnifies losses. What matters now is timing. Stage 3 historically lasts between 18 and 36 months. It is not a single event. It is a transition. During this phase, narratives conflict. Optimism and warning coexist. Volatility increases. Policy responses become reactive rather than strategic. Confidence oscillates. This is when positioning matters most. The goal is not prediction. The exact trigger of stage 4 is always different. A banking event? A currency shock? A geopolitical crisis? A policy mistake? The trigger. As stage 3 deepens, the most important shift is not what markets do, but how participants think. Confidence stops being assumed and starts being calculated. Investors no longer ask how high assets can go, but how exposed they are if conditions change. This psychological transition is subtle, but it marks the point where systems become unstable. Stability relies on shared belief. Once belief fractures, even slightly, behavior changes faster than policy can respond. In late-stage cycles, central banks face an impossible mandate. They must defend confidence without triggering collapse. If they tighten too aggressively, leverage structures break. If they loosen too much, currency credibility erodes. There is no neutral option. Every choice shifts risks somewhere else. This is why policy signals become inconsistent. 1 month tightening, the next month liquidity injections. Markets interpret this not as control, but as stress. The bond market is usually the first to detect this stress. Long-term yields rising, despite intervention signal declining confidence in future purchasing power. Investors demand compensation not just for time, but for uncertainty. This is critical. When yields rise while debt levels are high, the system enters a reflexive loop. Higher yields increase interest expense. Higher expense increases deficits. Higher deficits require more issuance. More issuance pushes yields higher. This loop does not require panic, it only requires arithmetic. During previous reserve currency declines, governments attempted to manage this loop through repression, yield controls, capital controls, financial regulation disguised as stability policy. These measures slow capital flight temporarily, but they also signal weakness. Restrictions tell investors that exit may not always be voluntary. That alone accelerates diversification. At the same time, inequality becomes more visible. Asset holders are protected longer than wage earners. Those closest to liquidity access adapt first. Those dependent on fixed income feel pressure last, but hardest. This divergence fuels political tension. Populism rises. Polarization intensifies. Fiscal promises expand even as fiscal capacity shrinks. The gap between expectation and reality widens. This is not accidental. Late-stage monetary systems incentivize consumption over production, debt over savings, speculation over investment. Over time, productive capacity erodes relative to financial activity. When adjustment comes, there is less real output to absorb shock. That is why recoveries after reserve currency loss are slow and painful. Another critical feature of Stage 3 is mispricing of risk. Because intervention has suppressed volatility for years, participants underestimate how quickly conditions can change. Models based on recent history fail. Correlations shift. Safe assets behave differently. Liquidity disappears where it was assumed permanent. This is when portfolios built for stability suddenly experience instability. Geopolitically, fragmentation accelerates. Trust between blocs declines. Trade becomes conditional. Energy, food, and strategic materials are securitized. Supply chains shorten. Efficiency gives way to redundancy. This transition is inflationary by nature. It raises costs while reducing flexibility. Monetary policy cannot easily offset this without further debasement. As alternatives develop, reserve currency usage declines at the margins. Central banks diversify quietly. Sovereign funds adjust mandates. Multinationals hedge exposure differently. None of this makes headlines, but it changes flows. Over time, flows shape outcomes. The final misconception to address is the belief that reserve currency status is permanent because it is convenient. Convenience follows power. Power follows credibility. Credibility follows discipline. When discipline weakens, convenience erodes. History is clear on this point. What makes the current moment unique is not inevitability, but optionality. Individuals and institutions still have choices. Stage 3 is the window where repositioning is possible without panic pricing. Liquidity still exists, markets still function. That will not always be the case. The purpose of understanding this cycle is not fear, but agency. Awareness expands decision space. Those who recognize the pattern can adapt behavior, reduce exposure, and increase resilience. Those who deny it become dependent on policy outcomes they do not control. Preparation does not mean abandoning the system. It means not being trapped by it. It means balancing assets, managing leverage, preserving optionality, prioritizing flexibility over optimization. These principles have protected wealth through every major transition in history. As Stage 3 progresses, signals will intensify. Volatility will cluster, policy responses will shorten, narratives will shift faster. The temptation will be to seek certainty. There will be none. The only certainty is that systems under this level of strain do not remain static. The next phase does not arrive with an announcement. It arrives when confidence tips, when the marginal buyer hesitates, when liquidity demands a premium, when trust costs more than yield. Stage 4 does not begin with collapse. It begins with realization. The realization that the old rules no longer guarantee stability, that intervention no longer restores confidence, only delays consequence, that growth driven by leverage has reached its limit. This moment is rarely obvious while it is happening. It only becomes clear in hindsight after the adjustment has already done damage. When Stage 4 unfolds, it does so unevenly. It does not destroy everything at once. It reorders value. Certain assets fail quickly. Others appear resilient until they are not. Liquidity becomes selective. Credit becomes conditional. Trust becomes expensive. This is why most people misread the early phase. They expect chaos. What they get instead is confusion. Markets open. Prices move. Institutions function. But beneath that appearance, assumptions have changed. The defining feature of Stage 4 is loss of monetary credibility. Not collapse, but doubt. Doubt about future purchasing power. Doubt about policy consistency. Doubt about the ability to exit positions when needed. Once doubt enters the system, behavior shifts. Investors shorten duration. Consumers accelerate spending. Lenders demand higher premiums. Each action reinforces the next. Governments respond with familiar tools: stimulus, guarantees, regulatory adjustments, narrative management. These measures can slow panic, but they cannot restore trust once credibility has been questioned. Trust is asymmetric. It takes decades to build and moments to fracture. When reserve currency trust erodes, the system becomes unstable by definition. This instability expresses itself through volatility, not just in markets, but in expectations. Inflation expectations decouple from official targets. Interest rate signals conflict. Currency markets become reactive. Capital flows reverse unpredictably. Correlations that held for decades break. Models fail because they assume stability that no longer exists. At the societal level, the impact becomes visible through purchasing power. Wages lag prices. Savings lose real value. Fixed income becomes fixed loss. Social tension rises as promises made under old assumptions become unpayable under new conditions. Political systems strain under competing demands for protection and relief. This is not a moral failure. It is a mechanical one. Debt-based systems depend on growth exceeding obligation. When obligation outpaces growth, adjustment is inevitable. The adjustment can be explicit or hidden. Inflation is hidden default. Currency debasement is silent restructuring. Financial repression is controlled erosion. All are forms of resolution. The danger is not collapse itself. The danger is being unprepared when adjustment arrives. History shows that those who survive transitions are not those with the highest returns, but those with the greatest flexibility. Liquidity matters. Diversification matters. Optionality matters. This is why understanding cycles matters more than predicting events. Events are noise. Cycles are structure. Structure determines outcome. Spain collapsed not because of one war, but because debt exceeded capacity. The Dutch Republic fell not because of invasion, but because financial credibility eroded. Britain lost reserve status not because of defeat, but because obligation exceeded control. The current system is governed by the same constraints. Different technology, same mathematics, different scale, same behavior. Stage 4 does not mean the end of economic activity. It means the end of an era, a transition from one monetary order to another. Such transitions have occurred many times. They are disruptive, but survivable. They reward those who adapt early and punish those who assume permanence. The most important adjustment is psychological. Letting go of the belief that stability is guaranteed, that policy can eliminate cycles, that reserve status is eternal. These beliefs are comforting but false. Systems evolve, power shifts, currencies change. The question is not if, but how smoothly. Preparation does not require extreme action. It requires balance. Reducing concentration risk, avoiding excessive leverage, maintaining liquidity, investing in real productive assets, preserving human capital. These principles have endured across every monetary transition. The next phase will not announce itself. It will arrive gradually, then suddenly, confidence will slip quietly. Then behavior will change. By the time consensus forms, positioning will already be too late. This is not pessimism. It is pattern recognition. Patterns do not require belief to operate. They require only time and pressure. The purpose of this analysis is not fear. It is clarity. Clarity removes surprise. Surprise destroys capital. Awareness restores agency. History does not repeat exactly, but it rhymes with precision. The rhyme we are hearing now is familiar to anyone who has studied prior transitions. Debt accumulation, capital diversification, monetary experimentation, credibility strain. Stage 4 is not inevitable in its severity, but adjustment is inevitable.